Okay, what a week. If you felt like the economy was giving you whiplash, you are not alone. We saw the stock market hit these incredible new highs, only to see a big sell-off right after. And the Federal Reserve? They made a huge move that somehow seemed to create more questions than it answered. So let's try to make sense of it all.
And this really is the million-dollar question, isn't it? I mean, on paper, a rate cut from the Fed is supposed to be a good thing. It makes borrowing money cheaper, which should get the economy humming. But that's not quite what we saw. The markets got jittery. So what was going on?
This slide just lays out the contradiction perfectly. On the one side, you have all the stuff that should make you optimistic, right? The Fed is cutting rates, stocks are hitting records, awesome. But then you look at the other side. The Fed itself is warning about inflation, and by Friday, the markets were in the red. It was a classic case of one step forward, two steps back. All right, to really figure this out, we have to start with the policy decisions. The market wasn't just reacting to a single headline. It was trying to read between the lines of some really confusing messages coming out of Washington, especially around two huge events. And here it is, the big number of the week. The Federal Reserve cut its main interest rate by 25 basis points. That's just a fancy way of saying 0.25%. This was a big deal, bringing the rate to its lowest point since late 2022. So that's the action, but the real story is in how everyone reacted to it. And here is the catch. In the exact same statement where they announced the cut, the Fed dropped this line, saying inflation remains somewhat elevated. Now hold on. You cut rates to boost a slowing economy, but you fight inflation by raising rates. So doing both at once? It's like hitting the gas and the brake at the same time. Wall Street calls this a hawkish cut, and it sent a very mixed signal. And the confusion didn't stop there. The vote to cut rates wasn't even unanimous. 2 members voted against it. Then you had Fed Chair Powell giving a press conference where he sounded pretty resistant to the idea of more cuts. So of course, no one knew what to expect for their December meeting. And get this, U.S. Treasury yields actually went up. That's the complete opposite of what's supposed to happen after a rate cut. As if all the drama with the Fed wasn't enough to keep us busy, the other big story was the U.S.-China meeting at the APEC summit. Now, they announced a deal, which sounds great. But just like everything else this week, the devil was absolutely in the details. So you look at the fine print, and you see the problem. Yeah, the U.S. made a concession on fentanyl tariffs, and China agreed to delay some export curbs. But look closer. All the old restrictions are still there. And that big promise from China to buy more American soybeans, well, that only happens if other tariffs are lifted first. This wasn't some grand breakthrough. It was more like a very fragile, very temporary truce. So, let's put it all together. You've got a really confusing message from the world's most important central bank in a trade deal that's full of holes. All of that uncertainty just poured straight into the market, and investors, well, they got pretty anxious. Let's see how it played out day by day.
The reaction on Wednesday, right after the Fed's announcement, was just weird. The broader market, the Dow and the S&P 500, kind of shrugged and dipped a little. But then you have the NASDAQ, which is full of tech stocks, and it actually went up, even hitting a new all-time high. For a hot second, it looked like tech was invincible.
Yeah, that optimism didn't last long at all. Thursday rolled around and we saw a huge reversal. The very sector that had been holding everything up suddenly started dragging it all down. And it was a sharp drop. The NASDAQ fell over 1.5%. So what was the trigger? Investors started looking at the spending forecasts from some of the tech giants, and they got spooked. It seemed like even the biggest companies were getting ready for tougher times ahead, and that was enough to send the whole market lower. Now, it wasn't just tech that was feeling the pain. Another really important part of the economy was under a lot of pressure: the banks. All this back and forth about interest rates in the economy put financial companies in a really tough spot.
And to get why, you gotta understand this one idea: net interest margin, or NIM for short. Basically, it's how banks make money. They earn more on the loans they give out than they pay on the deposits you keep there. But when nobody knows where interest rates are headed, it's almost impossible for a bank to predict its profits. And that's exactly the kind of fog the Fed created this week. So you can see the financial sector was getting hit from all sides. You have unpredictable interest rates, a cooling economy, and growing worries about whether people and businesses can actually pay back their loans. And to top it all off, a government shutdown meant that a key inflation report was delayed. More uncertainty on top of uncertainty. Okay, let's zoom out for a second. Because beyond all the day-to-day chaos in the markets, what happened this week really plugs into a much bigger story. It's this epic tug-of-war happening in the economy between some pretty deep risks and some potentially massive rewards.
On the risk side of things, you've got this really stark warning from the International Monetary Fund, the IMF. In their latest report, they basically said that markets are acting a little too calm and seem to be ignoring some elevated risks to the whole global financial system.
So what's the IMF worried about specifically? Well, they're pointing to things like asset prices that look way too high, growing stress in the government bond markets around the world, and of course, the trade tensions that just won't go away. In other words, they're saying the foundation might have some cracks.
But, and this is a really big but, that's only one side of the coin. While you have these global institutions flashing warning signs, there is this incredibly powerful force for optimism, and it's being driven by a tech revolution that is really just getting started.
Get a load of this number. Economists at Goldman Sachs think that generative AI could boost U.S. labor productivity by a whopping 15% over the next decade. Now, that is not a small number. That is a massive, potentially economy-altering force that could completely change the game for economic growth.
So, we have a Fed sending mixed signals, a shaky trade deal, a nervous market, huge global risks, but also a once-in-a-generation AI boom. What on earth does it all mean, and how are we supposed to figure out where we're going from here?
When you boil it all down, the economy is basically telling two completely different stories at the same time. You've got the bull case, the optimistic view that says the Fed will have our back and this AI boom is going to create a ton of prosperity. And then you've got the bear case, the pessimistic one, that says stubborn inflation and global risks are going to win out. Right now, the market is caught smack in the middle of that tug-of-war.
And that leaves us with one last question. With all these conflicting signals flying around, what's the one thing we should really be paying attention to? Well, it probably comes back to the two things that caused all the confusion in the first place: inflation numbers and whatever the Fed does next. What the Federal Reserve signals at its December meeting, that could be what finally tells us which one of these two stories is going to win out.